Hello, I'm David Mandy, president of O&M Partners. I want to welcome everyone today to the Seabridge Gold Town Hall webinar. Seabridge Gold trades under the symbol SA on the New York Stock Exchange. For those of you who are new to these broadcasts, about 6 years ago, O&M recognized the sea change in non-deal investing. Suddenly information was more available to a whole new generation of self-directed investors that can't be found in key financial centers. Investors are receiving information at home that used to be geared and available only to professional investors in conference rooms. The questions in Q&A are for everyone. Questions will be easily answered by going to the question portal, go to webinar, or you can email us. Any questions that remain unanswered, be assured we'll follow up in a timely manner after the call. Before we turn to our host, very pleased to introduce our introductory speaker today, Jim Anthony. Jim is a private investor, but most importantly, he co-founded Seabridge Gold, and he's helped to finance and advise a number of junior gold producers and exploration companies over the past 30 years. Jim writes gold market commentary for Seabridge Gold's financial reports and is regularly consulted on the gold market by institutional investors in North America and Europe. Originally a student of economics, Jim has become a disciple of the markets. As he likes to say, the tape can tell you much more than any economic model. On that note, it's a pleasure to turn the call over to Jim Anthony.
Thanks very much. We'll start by looking at the economic outlook. Rudy, if you want to take control of the slides here. And we're coming
Sorry,
up.
Jim. Here we go.
All right. Aha. Good. There we are.
Right.
So looking at the economic outlook for 2021, the bulls are expecting some really strong economic growth in the first half due to vaccines. Have we heard about anything else lately? Plus some added stimulus, and most commentators are saying no inflation. Actually, the fly in the ointment is going to be inflation, we think. And you'll note from the bond market, where I think there's more truth generally than there is in the stock market, that inflation expectations are on the rise. Look at the 5-year and 10-year break-evens on tips, and you'll see what I'm talking about. We're saying something quite different. Our view is that serious damage has been done to corporate balance sheets. The labor market, and incidentally, that's now playing out in a second wave of corporate cutbacks, reductions in capital spending plans, which will play out in next year. The labor market is very weak and getting weaker. The economy has been held together by unprecedented fiscal stimulus. So you haven't really seen the damage that's been done underneath the surface because of all the money printing. Millions of consumers are at the breaking point, which we'll show in just a moment. And so therefore we expect massive fiscal stimulus will be required in the coming year, financed by the Fed's quantitative easing. So next slide. Rudy, yeah, there we go. Oops. Okay, here we are. So if we're going to look at the economy, we really need to look at the labor market. Probably some of you saw the initial claims report this morning. Initial jobless claims are running at 4 times pre-COVID levels. They're up significantly this week over last. The latest ISM data, the jobs index, was negative for the first time since March. The November jobs report was a disaster, only 245,000 jobs added compared to 470,000 expected and 610,000 for the month before. It looks like the December jobs report is likely to be negative. So in other words, contraction. If you look at the chart lower left, the payrolls change. You can see the sharp red line down. That's March and April. That's when the job situation became catastrophic. And then you see the rebound, which looked initially pretty good. The green lines to the right of the red, but it suddenly got much weaker, and in fact has been very disappointing. So then if you look at the chart on the right, 14 million workers are set to lose their unemployment benefits at the end of this month. And the graph part of it shows you that employment levels in small business have regained about half of their losses, but are now unfortunately trending downward again. Not a good sign. So next slide.
Sorry, Jim, I'm having problems with this.
Yeah, I can see. That's okay. We'll do it.
Rudy, if you like, I could run this from my desktop.
Yep. Okay, let's do that.
Yeah, you can do that. I apologize. I stopped responding.
It'll just take a second. Thank you, everyone, for your patience.
Okay, let me know if you're seeing that.
We are indeed.
Okay. All right, is that the slide you want, Jim?
Next slide.
Okay. How?
Still waiting.
One second.
Fed's dilemma.
That's
Nope.
dilemma.
Is that where you want it, Jim?
Yeah.
Fed's-
Okay. There we go. Thank you.
Okay. Thank you for your patience.
We had immense fiscal deficit spending in 2020, which wasn't enough actually to meet demands for COVID-19 requirements. If you look at some of the below the surface numbers, the U.S. Census Bureau is telling us that 17.8 million U.S. adults are currently behind in their rent or mortgage payments. They predict that 5.8 million of them will be evicted at the end of this month. The Moody's tells us that about $70 billion in unpaid rent and mortgage payments exist out there. And the moratorium that has been holding things in place is expiring at the end of this month. So the gloss that's been put over the unfolding recession beneath the surface is explained by the fact that 25% of household income in the third quarter of this year came from government transfer payments. It's unbelievable largesse, and it's kept things ticking, temporarily at least. But the real story is that 75% of Americans don't have $500 in cash to meet an emergency. So where are we headed? We're headed toward yet larger deficits. The deficit for this year, for the fiscal year ended October, was 3.1 trillion, which was the forecast by the CBO once COVID got rolling. We expect another 3 trillion this year. You'll note that federal expenditures for 2020 were actually double tax revenues, an absolutely astounding number. So this year, $3 trillion will take the deficit to the debt to at least $30 trillion by year end next year. In 2020, the addition to the Fed's balance sheet was almost exactly equal to the increase in the debt. The Fed will try to tell you it's not monetizing debt. All central bankers say that. They are. There's no question about it. The Fed will have to do at least $3 trillion this year to fund the deficit, and the current pace is only $1 trillion a year, about 80 billion a month. And they're going to have to do it because foreign ownership of US treasuries is at a 10-year low and it's dropping. And if you look to the right, you can see that of the $27 trillion in total US debt, 208 since 2008, we've got 17 trillion of that, or 63%, of the entire amount. It's accelerating. There's no reason to think it's not going to continue to accelerate. Next slide, please. So this brings us to the Fed's dilemma and a very important chart on the right. The Treasury is going to flood the market with net new issuance. That's for sure. And that puts upward pressure on interest rates. We already have inflation expectations in the bond market pushing rates up as we speak, which is one of the headwinds for gold over the past 4 months. And you can see that also in the fact that the net speculative short position in long duration treasuries is at an all-time high. The Fed can't afford to see rates go up. We know that from 2018 when they did rise due to quantitative tightening, and it was a disaster. Over 20% of US public companies are now zombies. That is, their operating profits don't cover their interest payment. We therefore think it highly likely that the Fed is going to implement yield control in 2021. Yield control meaning that they will cap long-term rates just the way they've capped short-term rates. They will do that by buying whatever is necessary to keep rates within the predetermined range. Now, if you look at the chart, the gold price happily, that's the red line, happily rises as the inflation-adjusted 10-year Treasury rate, the blue line, drops until you get to the end of that blue line and it ticks up. That tick up is the increase in real rates that has taken place in the last 4 months. That increase, by the way, leaves that rate still in negative territory, but the trend being up has taken the gold price down, or at least put a cap on it. The Fed doesn't want that tick up in the blue line any more than holders of gold and gold stocks do. Next slide, please. So for next year, we expect a very gold-friendly Fed policy starting very early in the year. We see an increased quantitative easing fiscal stimulus program, which will further weaken the US dollar. We'd like to note that the dollar recently broke its 52-week low, and it's looking rather weak despite the fact that it has a record speculative short position. Yield control that we're expecting will lower real yields, which is the best thing you can do for gold. And that's going to drive investors from bonds to gold. Some very interesting numbers here. The chart on the left is courtesy of Ray Dalio, who really provides some very interesting stuff from time to time. The historic percentage of global debt in local currency yielding below 1% is over 80% now. And that's before inflation. So all of that is losing money. And then you go to the right and you see US corporate bond yields after inflation have now turned negative for the first time ever. So that US $100 trillion worth of bond debt, that's bond securities that's out there, most of that is losing money. And we think that's going to prove to be an enormous incentive to move toward gold and perhaps equities as well, but certainly gold. So that's the end of my part of the presentation. Rudy, over to you.
Thank you, Jim. Great presentation. Now we'll turn to Chairman, Chief Executive Officer of Seabridge, Rudy Frank. Pleasure to introduce him today. Rudy's, as most know, been in this business. He's had incredible amount of experience, 35 years. He was trained as a mining engineer at Columbia, and he's been in the mining industry, a very broad experience. He's involved in every stage of project development. But the story of Seabridge, he started in 1999. So a long commitment over 20 years. Rudy's been playing the long game. It's been impressive to watch. He's been a client for a long time. He successfully has created the best leverage play to rising gold prices. Seabridge has more gold per share than any company in the industry. In fact, it has more copper than most copper companies. As I said, we've worked with Rudy since 2006 and can attest to the fact that Seabridge's story is always developing. Rudy's always has news to report. He's never stopped creating value for his shareholders. And on that note, it's a pleasure to turn the call over to Rudy.
Rudy, before you begin, let me try to give you back presentation. I think it'd be easier if you ran it. Is that okay? And then I can do it if it won't work again.
Sure, we can try that. Happy to try that.
Is your presentation up?
I have to, why don't we just keep going? Because
Okay,
I don't want to.
sounds perfect.
Absolutely. Over to
So
you.
next slide, please. And thanks, David. You sure? It sounds like maybe you could give the rest of the presentation. I could just sit here and listen.
Yeah, well, I've been paying attention for a long time.
No.
It's a great time to be hearing a story.
Okay, can you move to the next slide, Scott? I'm still seeing the previous one.
There we
Okay,
go.
there we go. Yeah, so the case for Seabridge, I'm just going to hit on 3 points quickly because I have a lot to report today in terms of our announcement we made last Friday. Why own Seabridge? Well, we've got a 21-year track record now of demonstrating significant outperformance in our share price relative to the gold price or gold equities. If gold is going higher, like we obviously think it will, just own Seabridge shares. It's going to give you the best leverage going forward. Secondly, we own 100% of the world's largest undeveloped gold project, KSM in British Columbia. It just got bigger. Last week, we announced on Friday the acquisition of a deposit right next door to KSM that can be integrated into KSM that gives us another 35 million ounces of gold in the portfolio. And then last but not least, it's what we've been able to do on the exploration side. We've created a lot of value over the year by finding gold. In fact, our exploration team has found more gold over the past 15 years than any other company on the planet. And that includes the Newmonts and the Barricks and all the big guys that spend multiples of what we spend on exploration, or then anywhere clear the success we have. And over the past few years, while the market was a bit weakened, we took advantage of that and bought 3 new earlier stage projects on the exploration side, any one of which we believe could be a company maker that I'll cover briefly today. Next slide. This is a slide that I've been showing for years. It really tells our story. When Jim and I formed the company in October of 1999, gold was trading at about $2.60 an ounce. We believed it would go substantially higher over time, which obviously has, but we believe the best is yet to come. Our business model is simple. Create leverage to the price, and we do that by growing ounces in the ground faster than shares outstanding. We'll do acquisitions, we'll do exploration activities if we can convince ourselves that the dilution we suffer will be more than offset by accretion in ounces. And if you look at our track record over the long road here, we've delivered on that. In fact, now with the inclusion of Snowfield into our portfolio, we are now above 2 ounces per share in terms of resources. Next slide. Here you can see it in terms of reserves per share or resources per share. We provide 5 to 50 times more gold ownership per share than any other North American listed company. Next slide. And what this is translated into is significant outperformance. This is what we were hoping for when we formed Seabridge. Leverage for the gold price, outperforming gold and other gold equities. And we can now show a 21-year track record over the long haul, significant outperformance. Our shares are up almost 9,000% from when we started, compared to about 500% of the gold price. And then if you look at those periods of time when gold is in a real strong bull market, like from 2004 to 2007, and then again coming out of the financial crisis in 2008 to 2010, and then more recently coming out of the bottom in 2015 to where we are today. We do well when the gold price is rising, and we believe that the best is yet to come because we believe that gold prices will go to levels that will surprise a lot of people in the rearview mirror. Next slide, please. So one thing that Jim and I also learned in our careers is the concept of political risk. In a prior life, Jim and I built a number of mines in Central America, 2 of which were eventually expropriated by the government. Political risk is real in our space. As such, we decided to focus on what we thought were the two best jurisdictions in the world, namely Canada and the United States. And as you can see, that's the only playground we play in. All of our assets are located either in Canada or the United States. Next slide. Next slide, please. Obviously, the most significant asset we have right now in terms of value and in ounces and pounds of copper is KSM, a project we acquired from Placer Dome back in the year 2000. It's just amazing to me to see how this project has grown. When we bought this project, there were 3 million ounces of gold and 2 billion pounds of copper. With the addition of Snowfield now, we can now report 142 million ounces of gold, over 50 billion pounds of copper, and now over 700 million ounces of silver contained in economic resources. The project is located in the now famous Golden Triangle. A lot of the majors are starting to come into the area. Recently, Newmont came in, as did Newcrest, buying into projects just to the north of us and projects that are tiny compared to ours. Not only have we been successful in exploration and acquiring assets here, but we've also done well in terms of taking this project through the environmental assessment process. This project is now shovel ready, permits in hand, construction can begin. And to get to that point, we also work very closely with the First Nations and other local population centers to get them on side. In fact, we have impact benefit agreements in place with the Niska Nation and the Tahltan Nation. Next slide, please. The other big thing that's happened for us, but nothing doing by us, was actually the infrastructure that's now been put in place with other people's money. When we bought this project in the year 2000, logistics were horrible. Today, we have a major highway just to the east of KSM. To the south of us in the town of Stewart that's accessible along that highway. We have 2 new ports that will allow us to bring supplies in and take concentrate out. But probably most important, along that highway, the governments have spent over $700 million extending the power grid with hydro source power. We've now secured, through contracts with BC Hydro, the right to 250 megawatts from that line of power that we'll be able to buy for about 5 cents per kilowatt hour, some of the cheapest power in the world. Next slide, please. Okay, so here's the map. The blue line is our property boundary, which will change next week. Right now, we own Ironcap, Mitchell, Sulphurets, and Kerr. Collectively, those 4 deposits give us 7.6 billion tons of economic resources, either constrained with open pit shapes for the sake of Mitchell and Sulphurets, or block cave shapes for Kerr and Ironcap. The deposit we're buying is the one just to the right of us called Snowfield. This will allow us to add 35 million ounces of gold, 4 billion pounds of copper, and over 100 million ounces of silver into the greater KSM. Next slide, please. We did a pre-feas in 2016 that was used as the basis to get our permits. We now have our permits in hand. Construction can begin. If you look at the numbers on the pre-feas, we had a mine plan in the pre-feas that had 2 open pits and 2 block caves that collectively captured 39 million ounces of gold in reserves and just over 10 billion pounds of copper. And at a $12.30 gold price and a $2.75 copper price, the project generated an after-tax net present value of just over $1 billion US. If you use higher gold prices and higher copper prices, the numbers change dramatically. Next slide, please. What that mine plan did not yet include, however, are the higher grade copper zones we've added, Deep Kerr and Ironcap. In fact, earlier this year, we actually did an updated technical report to show the impact of Deep Kerr and Lower Ironcap into the project plan through large block caves. It showed a significantly improved project, capturing inferred resources from these 2 deposits. I think the all-in cost of production went from $670 down to essentially 0. Unfortunately, the OSC has determined that because we have the same type, some of the same material in both our PFS and our new mine plan, we can't show them both together. So we had to revise our technical study to remove the 2020 PEA, although the OSC commented to us and put this in a press release that either study is exemplary on its own, satisfies 43101, but they just can't be shown together. That's okay, because what we're going to do next actually will make the project even better. Next slide, please. So by taking Snowfield into KSM, what will this do for us? Well, first, to show you the value we got for this, we're buying this for $100 million US in cash. We actually announced at the same time of announcing the acquisition, we announced a bought deal financing led by Cantor Fitzgerald. We closed on that financing yesterday. Not only did they give us the full $105 million that they agreed to on the bought deal basis, but they exercised the green shoe immediately, taking it to $115 million that came into our pockets yesterday morning. What we get for this is 35 million ounces of gold. What we issued to raise the $100 million was 6 million shares. So on the front end, we're getting almost 6 ounces of gold per common share for this acquisition. You can think of it another way. We're buying 35 million ounces for $100 million. We're paying $3 an ounce for a deposit that sits right next to our biggest deposit at KSM. In fact, we believe that Snowfield is the sheared off top of Mitchell that was displaced by a fault tens of millions of years ago up the valley. So I think we kind of view it that Snowfield is finally coming back home. But I will say from Pretium's side, yeah, the deal looks great from us. Low entry cost, great addition to KSM. But from Pretium's perspective, I think you have to recognize what their mandate is. They now have successfully built the Brucejack mine just to the south of us. That's actually just east of Kerr. They took on a lot of debt to build that mine, and one of their corporate mandates from new management is to pay down debt. And the $100 million will go right down to debt repayment to them. So we always talk about win-win deals. Seldom are they win-win. One company always does better than the other. I truly believe that in this case, it is a win-win. Pretium gets what they want to get in terms of paying down debt, and we get a new deposit here that can substantially improve the overall economics of KSM. Next slide, please. So why can it improve it? Well, first of all, of the 35 million ounces of resources at Snowfield, 26 million ounces are measured and indicated. The nice thing about measured and indicated resources is they actually can become proven and probable gold reserves without having to upgrade them with additional drilling. So right now we already have 25.9 million ounces that we can look on to bring into our mine plan. Those of you that have been following us for years know that we tend to limit our mine plans by what we have permitted. Right now with Snowfield, we'll have 9.8 billion tons of resources available to us in our now 5 deposits. We're permitted for 2.4 billion tons. So we want to find what is the best 2.4 billion tons to fill up that tailings management facility. When we look at Snowfield, just unbelievable additions right on the front end. First of all, Snowfield comes at a strip ratio of about 0.5 to 1, one of the lowest strip ratios I've ever seen for a deposit of this size. Secondly, back in 2011, when we actually did some joint studies with Pretium to see how Snowfield could fit within the greater KSM, we did metallurgical test work to show that Snowfield can successfully be blended with Mitchell ore and produce a very, very saleable concentrate. Next important thing is that we already have the facilities permitted in terms of waste rock storage and tailings facility. Mining Snowfields, the ore that's produced from that and the waste that's produced from that can fit into our approved tailings capacity. So we don't need to make any changes. And last but not least is that the upfront capital doesn't change. We'll be building the same mine we would be building with or without Snowfield, just that the mine plan will change because we can bring in higher grade gold on the front end at a much lower strip ratio. So we now are in the process of updating our pre-feasibility study. We expect to have that done perhaps as early as a year from now, showing a much improved project with lower waste rock, higher reserves, and much improved net present value, internal rates of returns, and payback periods. Probably the most important thing from our perspective, though, is what this means in terms of our partnership negotiations. As many of you know, we've been talking about a partnership at KSM now for a long time. In fact, we have turned down 5 proposals from 5 of the largest mining companies on the planet. We can now show a project that is not only more robust in terms of economics, de-risked in terms of not having to develop block cave mines, but a project that can go open pit mining for decades before you even need to consider to bring iron cap or deep Kerr into the mine mix. If you want to go after the copper earlier, though, that's there for you as an optionality. So we are very excited about what this means in terms of ounces per share, in terms of accretiveness to the project, but probably most importantly in terms of getting our deal done on a joint venture on terms that we can say yes to. Next slide, please. I'm sure we'll have lots of questions on Snowfield. I'm just going to run through our other assets extremely quickly, and then we can come back. Next slide, please. So Courageous Lake is our other big asset in the portfolio. It sits in the Northwest Territories, 11 million ounces of gold resources, hosting 6.5 million ounces of proven and probable gold reserves. Next slide, please. We did a pre-feas on this in 2012 at a time when the Canadian dollar was essentially at par with the US dollar, which is not good for Canadian assets. And the project back then showed it was a marginal project, to be totally honest. However, if you make the changes to the gold price and changes to the exchange rate, what was marginal back then looks very different today. Last year, we also took a look, is there a smaller starter project here that you can build for a lot less capital and then go to the bigger project later? And indeed there is. We are now looking at the best path forward. Many of you may remember back in the early years of Seabridge, we were not adverse to selling non-core assets as a way of generating proceeds without having to go through share dilution to fund projects like KSM. We think that Courageous Lake could represent such an opportunity. We are now working with a banker to see what kind of value we can unlock, either through a sale or a joint venture process. If we don't get anything that makes sense to us, we'll just hang on to it. Holding on to ounces in the ground never hurts you. Next slide, please. Where we are excited, though, are the 3 earlier stage exploration plays we now have. As many of you know, that's where we've really made our name, is finding gold and opportunities that were missed by others. Next slide, please. Biscuit is a project that is very close to KSM, only 40 kilometers, but more importantly, we think it could be another KSM. We are now focusing in on porphyry, gold, copper opportunities. Next slide, please. This year, we actually had our first drilling program, vectoring into what we think could be a gold copper porphyry. We actually hit gold and copper, which we think is evidence of still being too high in the system, but clearly evidence that it's a big system with opportunities below us. We'll be in the process now of looking at what next year's program might look like to continue to vector into where we think the part of the system could be. Next slide, please. Second exploration asset is Snowstorm. Next slide, please. A project that we acquired from John Paulson out of New York in 2017. A project that sits on the intersection of the 3 most prolific gold belts in Nevada, but more importantly, just north of the Twin Creeks mine and the Turquoise Ridge mine, that are now 2 big mines that are part of the Nevada joint venture between Newmont and Barrick, operated by Barrick. Our focus here is to find that type of mineralization as you see at Getchell and Twin Creeks. Next slide, please. Last year, we had our first drill program looking for those types of targets. We confirmed that we had the right rocks, the right structural setting, and the right alteration patterns. We are now on to our second drill program, drilling about 5,000 meters, mostly core. That program will run into next year and have results to report. Obviously, if we can find something here that's in close proximity to 2 of the biggest mines in Nevada. Actually, when you stand on the top of our top of our project there, we actually look down the valley and see this mine. So obviously, if we find something here, it will be meaningful to our shareholders in terms of value. So stay tuned on that. Next slide, please. An acquisition we completed this year at the height of COVID was buying the 3 Aces project in the Yukon from Predator Gold. Next slide, please. This is a project, it's really more of a district. It's over 300 square kilometers, 35 kilometers of strike length of known gold showings up and down the entire belt. Next slide, please. We actually, if you look at some of the historic drilling that's been done here by Golden Predator and others, you can see right at the surface, multiple meter widths of assays upwards of 1, 2, and even approaching 3 ounces per ton right to the surface. We believe that the system has legs. That's why we bought it. We're now in the process of putting together a 3D database, combining all of the drilling data, the geochemical data, and the geophysical data building our own 3 model, and we will have our first drill program at 3 ACES in 2021. This is exciting in that it could create, for the first time within Seabridge, a very high-grade element to our story. Next slide, please. So wrapping it up, why Seabridge? 21-year track record of unparalleled leverage in the gold market. KSM is a world-class asset that just got better with the inclusion of Snowfield. We believe that this will propel us to getting a deal done on terms that we can finally say yes to. And finally, a portfolio now of 3 earlier stage exploration projects to hopefully replicate the success we had with KSM and Courageous Lake when we took those on as early stage exploration projects. And one more slide. We're fairly well covered now. A lot of the names here actually were in the syndicate on the financing. I will tell you that Cantor Fitzgerald, Mike Kozak, came out with a research report today, increasing his target price by $8 a share. And also the analyst at Red Cloud, Derek McPherson, just increased his target price north of $80 per share Canadian, both based on the acquisition of Snowfield. Low share count, only 74 million shares outstanding, and I think that's something we're proud of. If you look at most companies in our space, even without any resources, they tend to have hundreds of millions of shares outstanding. We don't. And then most importantly, I think, is the insider ownership. Insiders continue to own a very, very big share of this company, pushing 40%. And one comment I'll make on the financing we just completed, almost 80% of the $115 million came in from existing shareholders. So well supported in the deal, shareholders want to participate, and I think over time, as we unlock the value of Snowfield into the market, I think our share price is going to go back through its all-time highs. So with that, I'm happy to answer any questions, David.
Thank you, Rudy. Well presented. We'll start with Mike Hahn. Mike, good to have you on the call. Just unmute him. Just give a sec. Okay, Mike, we'll come back to you. Or you can also text in your question. We'll turn to Steve Shipman. Stephen?
Sorry, am I unmuted now?
We can hear you, Stephen. Absolutely.
Hey, Rudy, how are you?
I'm well, Stephen. Good to hear from you.
Yeah, good to see you as always. Question, for Snowfield, is the intention there to just build out ounces like you did with your original project and make that shovel ready for someone else? Or are you actually looking to transform the company into a producer not Snowfield, at the Nevada property?
No, I think one of our guiding principles from day one is to build a mine. Jim and I did that in a prior life, and
Yep.
it was a happy ending. Trying to transform an exploration development company to a producing company is a very difficult transition to make. We're willing to give away some of the upside in terms of partnerships and joint ventures, maintain a meaningful interest in the project while minimizing our capital contribution. So no, we will never build a mine ourselves. We will partner them up or sell them at the right time, at the right price. In the case of Snowfield, we don't need to find any more ounces. They've already been found there. I mean, you know, we started looking at this asset, to be honest, when it was still owned by Silver Standard. We actually tried to buy it back in 2008 when Silver Standard owned it. They didn't like my bid. Okay, we went our separate ways. They eventually then sold Snowfield and Brucejack to Pretium when Bob Quartermain formed that company. I think the launch of Pretium was a $500 million payment to Silver Standard to buy both assets. And on the books of Pretium, it was booked for over $200 million, about half of the acquisition cost. And it's only grown a bit in book value since then. And it wasn't until we had common vision between ourselves and Pretium that, you know, let's get a deal done on here that's a win-win for both companies. We tried to buy this when Pretium first bought this in 2011. We actually did a joint study with them to show how Snowfield could fit into the greater KSM. And even back then, it became clear to us, yeah, it made sense, but not at the price they wanted to sell it for then. So it only came together here with the new management team in Pretium focusing on their core asset, which is Brucejack.
Great. Thank you so much. Good luck.
Thank you.
Thank you, Steve. We'll turn to Stratos. Stratos, do you have a question today for Rudy?
Hello?
We can
Hello.
hear you.
Yeah. Rudy, thanks very much for the presentation. For the last few years, I know that the main priority of the company has been to find a partner for the KSM. Is it still on the cards, or now the priority has shifted to selling the Courageous Lake? And the last year that the gold price has appreciated so much, have you seen any interest for the KSM from, let's say, the previous interested parties or any new ones? And anyway, how does it look at the moment?
Yeah, so our top priority is to get a joint venture done in KSM. It's been so for the past few years. We've gotten close a few times. We have received proposals. We just haven't gotten the deal terms that we can say yes to. In fact, going into 2020, there was a syndicate we were dealing with that had promised us a proposal by the end of March along a structure that we had pre-cleared with them. And then when COVID hit, everything changed in terms of big companies pulling in their horns, concentrating on existing assets and keeping their people safe as they should. Now that that's coming to an end here and there's a path forward again, those same companies are still engaged with us. And I can tell you already that just since the announcement of the acquisition of Snowfield, other companies are now coming at us with renewed interest in what we have. So that is our top priority. I will, hear it from my lips. Nobody wants to get a deal done more than I do. I've got 95% of my net worth tied up in Seabridge common shares, but it's got to be on the right terms with the right partner. We are fortunate that we have a shareholder base that understands that and is patient, and we will get a deal done. And I think when we get the deal done, we'll all look back and say, yeah, it was worth the wait. In terms of Courageous Lake, that's not a big objective for us. If we can get value for it that we can say yes to, we'll transact on it. If not, we won't. I mean, it doesn't take any management time because we actually have a bank running the process for us. So we'll see where we can get on that. And I look at a project like was sold by New Gold called Blackwater. They sold it to a private equity group for almost $200 million in cash and kept a stream on it. Same size the asset as Courageous Lake. If we can get that kind of value on a sale process, why wouldn't we do that and then redeploy that money back into assets that we think we can drive more value with? So we'll just have to see how that plays out. There's not a gun to our head saying we have to sell it or joint venture it, but if we can get a deal that makes sense, we'll do it.
Thank you very much. That's great.
Thank you, Stratos. I think I saw Mike Hahn. Mike, are you unmuted now? Scott? I saw that he was unmuted. We always want Michael's questions.
Yeah, he reappeared for just a second. Let's give him a minute.
Okay.
He also texted in his question, which I could read now.
That'd be great. Perfect. Yep.
1 second. The question was, how far off are you with the strategic partners and what types of deals have been proposed?
All types. We had earn-ins to buy interest in the company, interest in the project, financial players, Chinese players, a lot of different interests. But those focusing in terms of big mining companies, they tended to be along the structure we're asking for, which is an increasing ownership in the project by increasing expenditures, sole funding of that to get to a construction decision, and then going out and arranging at least 50% of the project's capital requirements at a construction decision. We would like to hang on to at least 30% of this project, but not have to come up with more than 10% of the capital. Obviously, if we can keep more of it, we can fund more of it. As demonstrated in our ability to do $100 million bought deal financing, we do have access to capital. And then if we want to look at other ways of raising capital for our share of capital, they're there. But our goal is to minimize capital expenditures and maintain a meaningful interest. we got close a few times, and we'll get the deal done.
Great. Thanks for your question, Michael. We're going to turn to Nick Polidris. Nick, question today.
Yeah, I had one question on the NSR from the acquisition. What do you figure that adds as cost per ounce? I mean, you said $3, but realistically, that adds a little more.
Yeah, no, that's a fair comment. Depends on what gold price you use. So you use today's gold price, it's probably another $3 or $4. It's an NSR, so it's after smelter deductions and returns, so and after recovery. So yeah, it's gonna and obviously they wanted to keep some upside in it, which we're glad they do. We're neighbors there. Our success is their success, and vice versa. So yeah, I mean that's upside for them. We also actually agreed that when a feasibility study is delivered on KSM that includes reserves from Snowfield, that we would make a $20 million cash payment to them, 15 million of which actually is an advance payment against future royalties that will be owed on it. So nobody wants to write those royalty checks as much as we do. It means we're in production and the mine is up and running.
Okay, thank you. Excellent presentation.
Thank you.
Thanks for your question, Nick. We have Bob Hermanos. Bob, question today?
Congratulations on the acquisition.
Thank you.
Question, Bob, or is that? I know you've been following.
Yeah, I have a thought. Why do you think the shares went down on the acquisition?
Well, here's my theory. First of all, when you issue 6.1 million shares and you have a built-in profit within the first day or so, some people take those profits right away. But I think more important, it was interesting to note that the morning we announced the acquisition and the related financing, all of a sudden, one of the houses that has a position in our stock offered up 2.2 million shares of Seabridge available to borrow at less than a 2% interest rate. So we believe that there's been a fair bit of shorting going on in our stock with the anticipation that perhaps the financing is going to be hung or not get done. I think, as time plays out here, that's just more firepower built in for future buying, if I'm right on that. But I think it's pretty typical when you do a deal of this size. I mean, let's face it, this was almost 10% of our market cap that we just raised. That's a lot of dilution coming out at once, albeit offset by the accretion we get in the ounces. I think anytime you do a deal like that, it's not uncommon for your shares to trade down and even perhaps below what the issue price was. And I think that's all we're seeing here. I am 100% confident that as we move forward, that people will start to realize the value we get from this acquisition. And I'm in it for the long game, not just for a few days of trading.
Thanks for your question, Bob.
Right. Thank you.
Max Murray Vanderbilt. Max is unmuted.
Yep.
Mark?
Hi, Rudy. When I first saw the deal, I it was interesting because we talked, 5 or 10 years ago about why you couldn't put Snowfield together and wouldn't that make sense? And you sort of poo-pooed it. Maybe that's because you couldn't get the deal done. But the real question is, are you, given the partners you've been talking to, seems to me you, as a smaller company, could probably strike a better deal than, let's say, a Newmont or a Barrick could. And can you say whether there was any discussion about those guys said, gee, it'd be quite interesting if you could roll Snowfield into this?
I'll answer that, Mary, by saying confidentiality agreements are there for a reason. Any conversations we have with potential partners, I can't discuss with you.
Yeah, well, I tried. Thank you.
You're welcome.
Thanks very much, as always, Murray, being our call. We'll turn to Jeff Nasseri. Jeffrey?
Oh, yeah, we are. Okay. Hi, Rudy. Congratulations. And I think that was a superb acquisition. I know you've been thinking about it for a long time. and now you've got it. I would just like to reverse my usual question to you, which is why can't you spin out some of the other properties into a separate company? And you've given me very good tax reasons why that cannot be the case. But would you, if you close a joint venture, would you spin that out and keep all the rest?
Haven't even looked at that, to be honest. I have to look at that. I'd never considered that. I'm not sure how that would be treated from a tax basis. The problem always is on spin-outs with Canadian assets and Canadian company. Revenue Canada will determine your taxes a year or two after spin-out, and you got to pay taxes on the increased value there. Whether that works in terms of spinning out non-core assets or spinning out your major asset, I don't know. I'll have a look at that, but I imagine it'll be the same answer.
Okay, well, thank you. You've gone from strength to strength, and I think this is the best I've seen it. So congratulations and thank you.
Thank you, Jeff.
Thank you, Jeff. We'll turn to Howie Flinker. Howie, question today?
Hi, Rudy.
Hi, Howie.
David, Rudy and I traded some notes during the week, so I'm up to date. Thanks.
Okay. Thanks, Howie. Thanks for being on the call. We'll turn to Heinz Thoma.
Rudy, congratulations for the deal. Superb.
Thanks,
Now we
Heinz.
know why the previously announced webinars were delayed when you came out. It's a super deal. Just on the deal with potential partners, I assume that would be the whole KSM plus the other projects, right? That you would want to bring into the deal.
No, all we're talking about are 5 deposits at KSM. We're not going to include Iskit or any of the other projects we have.
Understood. Yeah, but the ones close to KSM would be included.
Correct. Not Iskit though, but the 5 deposits we now have within the KSM property boundaries will be included in the joint venture.
And the type of companies you were talking to, were they more base metal oriented or?
Both. We've been talking with the largest base metal companies and the largest gold companies. From our perspective, we think there's only 7 or 8 companies that have the technical, financial, and social wherewithal to build KSM. We're focusing on those. They tend to be the large North American listed companies. You can rattle off the names as easy as I can, and those are the ones that we're focusing on. And I think one of the big benefits we now have is if you look at the world of the big companies, before Snowfield, all of our mine plans always had a block caving component. Not all the big companies, actually very few of the big companies have real hands-on block caving experience of caves the size we're talking about. Now that we can show a project, at least one development scenario, that's open pit only for multiple decades, all of those that may have not been 100% interested in the asset, all of a sudden have a different view on it because the whole block caving question has been removed if they want it removed. Those that still want a block cave, it's still there as an option.
Thank you very much.
You're welcome.
David, I wanted to point out that Mike Hahn seems to be back on and has a follow-up. If
Great.
Can you hear me?
Yes, we can.
Oh, excellent. So sorry. Rudy, good to see you. So I just wanted, I was really interested in what you were saying about the strip ratio on Snowfield.
Yep.
So I just wanted to drill in on that, not to make a pun a little bit, and I want to just understand. So what percentage would you say the CapEx was stripping, in maybe the pre-fees or the PEA, and what percentage of the CapEx was for pre-stripping or costs or wherever it gets classified, and then what's the strip ratio of the original project, and how can we triangulate what you could save? Because I know it's going to take a year, but it does seem like there's some real value, and you've done such a good job over time, like just getting this project to be more and more economic. 5-6 years ago, and the gold price helped, of course, but even excluding that, you just seem to keep improving the project.
Yeah, so great question. I tend not to get questions with that kind of detail, but I'll do my best in answering it. Yeah, so if you look at the mine plan, the PFS mine plan, Mitchell and Sulphurets were open pits. In terms of pre-stripping to get to production, I think there was about $200 million in our capital for pre-stripping. Even Mitchell doesn't have any overburden, so there wasn't a lot of pre-stripping there. And the $200 million was included in the capital. If you looked at the PFS mine plan that included 2 open pits and 2 block caves, we would have mined, I think, about 1.5 billion tons of the 2.4 billion tons as open pits, and that would have generated about 3 billion tons of waste rock. So that would have been about a 2-to-1 strip ratio to get all the open pit tons out. As we look at it now with Snowfield, though, we believe that we can deliver all open pit and have the waste tons below the 3 billion tons we have permitted. Some initial work we've done on this suggests that perhaps the strip ratio will be less than 1-to-1 on a total basis now. So 2.4 billion tons of ore, 2.4 billion tons of waste, which is 600 million tons less than what we're permitted for, which is a big positive for the environment in terms of the footprint of waste rock, because obviously whatever you have in waste rock, there is pyrite in it. You're going to be generating acid. You're going to have to capture that water and treat it. Now we'd look like we'll have less tons to capture water from, which will lessen the environmental impact of the project. So this is another reason why Snowfield is so great. It's the proximity to Mitchell and the low strip, which helps quite a bit in terms of the economics.
And then just to follow up, then how do I think about the cost of block caving per ton versus open pit? Obviously, the capex to develop a block cave mine is more, and probably the operations too. So can you give us a little help there?
Yeah, so the big savings on in our pre-feasibility mine plan, I believe the portion of sustaining capital to develop the block caves was over $3 billion in sustaining capital.
Oh my God. Yeah.
That's not moved. That's gone. You don't have to spend that unless you want to go after the higher grade copper. The copper's there if you want to develop the caves, but you don't have to. So that's another reason why the NPV will be so much better, is because eliminating that sustaining capital. Yeah, the other thing is, even from a copper producer that may want to go after the block caves, we believe we can now show a mine plan in our PEA mine plan that started to bring in the block caves. You started spending money on block cave development in year 5. You got your money back maybe 1.5 times, and then you're going right back into developing the block caves. With Snowfield now, you can take the pressure off even a company that wants to develop the block cave and delay that investment into the block cave. In fact, we think that you can show somewhere between 10 to 15 years of open pit mining, getting your upfront capital back 3 to 4 times before you need to start developing the block cave. Again, just the optionality that Snowfield brings to mine development to either a copper producer or a gold producer is what we've never had that before.
And just finally, to make sure I understood, so it sounds like the capex, the overall capex of the project, probably when we see whatever you do in a year, don't expect that to drop huge, but expect the NPV to change because of the sustaining capital.
Yeah, the upfront capital won't change. We're still building the same tunnels. We're still building the same mill. We're still building the same access roads. We're still bringing the power line in from the main grid. So all that capital is the same in both development scenarios. The only thing that changes is the sequencing of the mining.
Okay, thank you so much, Rudy.
You're welcome.
Thanks, Mike. Always a pleasure having you on our calls. We'll turn to Doug Wow. Doug, question come to mind?
Well, as usual, Rudy has presented a fabulous outlook, and I have a few questions. So I'll just ask one off the wall sort of question. There was a rumor years ago that KSM and Snowfields had to join up because without the two of them together, there was no place to put the tailings. Is that true?
No. I think if you look at Snowfields on its own, if they didn't have our facility to use, they'd be very hard pressed to find a place to put tailings and even waste rock, because it's a really, you go up the valley there and you're dealing with glaciers. So I think, it works because we actually have that permitted and the space available. I think Snowfield on its own would be challenging because of tailings location and waste rock, but they can use ours now that it's part of KSM.
That's kind of what I was thinking about. Thank you very much.
You're welcome.
Congratulations on an
Thank you.
Doug. And then we'll turn to Brad Flower. Brad?
Yes, congratulations on the acquisition and a great presentation. I don't have any questions today. Thank you.
Thanks for being on the call, Brad. So we'll turn, does Adam Graff have a question? We've got Adam on the line with us. Always like. And then Scott, any other questions from the audience, the attendees?
Yes, we do have some. Let me just check in with Adam real quick. Adam, can you hear us?
I'm unmuted. All right. Can you hear me?
We can hear you, Adam.
Oh, great. Hey, Rudy, I'm just trying to remember back to the Snowfield's PEA. And my recollection was, basically they took your PEA and just dropped in their resource. And I was trying to remember, what kind of network they did, if any, to show that you can make a saleable concentrate with the grade of copper that they have at Snowfields.
Yeah, and that was a challenge to them, Adam, actually. If you go back and looked at the network that they did, they had to sacrifice recovery on both gold and copper to produce a con grade of 24, 25%, because the copper grade is that low. Obviously, the lower the copper grade, the harder it is to make a high grade concentrate that's sellable to a smelter. When we did our joint study with them in 2011, after they did their PEA, we actually did metallurgical test work jointly with them to show how Snowfield ore can be blended in with Mitchell and still not sacrifice recoveries and still generate a concentrate that's sellable any place in the Pacific Rim with no real significant impurities. We've done that work. We'll do some more work this coming season. Obviously, you want to do as much met work as possible. To get to a point where we can incorporate Snowfield into a new PFS, there's some things we want to do. Metallurgical test work will be some. We're pleased to see that actually they did do a bunch of geotechnical drilling, which we can incorporate. We may choose to do some more geotechnical drilling just to confirm the pit slopes that are appropriate. And then, when you buy an asset like this, you'll always poke a hole or two in just for reserve confirmation. But the amount of work we have to do on this asset to bring it to pre-feas is not that big of a number, and will not take that long either.
And then, Rudy, just talking about the gold and Snowfields again, is it located? Is the gold actually sitting within chalcopyrite, or is it going to come out in the tails that you have to leach?
Both. We'll get a good portion of. We'll probably get 70% or maybe 65 to 70% in the con, and then the balance, if it's high enough in the tails, we'll leach the tails. You remember, Adam, we actually designed in our tailings facility a central line cell that anything that touches cyanide will go there in a line facility. So we already have that built in. So the other nice thing is if you look at the block model that you have there, a lot of ounces come out very quickly because the very top portion has a very sweet high grade zone, much higher than the average for the overall deposit, which obviously helps in terms of early production and capital recoupment.
I also remember there was a molybdenum zone. Is that gonna maybe change your mind about putting in the molybdenum line?
Well, we have the moly circuit in our designs and we have it permitted. Whether we build it or not, we'll just have to see what the final metallurgy looks like with the Snowfield blended with Mitchell. It's more of a function, to be honest, of moly prices. Moly prices have a hard time going up because Freeport, with Henderson and Climax, they're always the swing producer. When it gets to a certain level, they ramp up production and then stop the price going higher. So, I think moly, to really be attractive to us, has to get to a higher price. And to be honest, even if you look at when we had the moly circuit on, the impact to the economics was de minimis.
Maybe you pour the foundation and you reserve the room for it, and then you just wait to see if you at some point if you want to build it or not.
Exactly.
Excellent. Thank you, Rudy.
You're welcome. Good hearing from you, Adam.
Jerry Needleman wanted to check in. Jerry, you're with us?
Very nice.
Ready. You have to unmute yourself, Jerry, if you can hear us. guess we'll check. Oh, there we go.
Okay. All right. Sorry about that. Anyway, just congrats again here. Rudy's never diluted the shareholders here all these years, and I think with Jim's great presentation, Jim Anthony's great presentation here, and I totally agree with that. We should see, the shares start moving up nicely in 2021. Maybe that's blackjack. I don't play blackjack, but maybe 21's a good number. And we'll see what happens. But I think it's just a great deal for both companies here from everything that I've heard. And I like what's going on. Long-time Seabridge shareholder. I'll own this thing either till I die or till Rudy sells the company. That's where I'm at. Anyway, God bless. Merry Christmas. Happy New Year to Jim and Rudy and your family.
Merry Christmas. Merry Christmas.
Thank you. I hope I get something done before you die.
Yeah.
Scott, any further questions?
Yeah, I have a question. John Bolin is on, and he doesn't have a mic, so he sent in his question. Rudy, you said there are only a handful of companies that could build KSM, and that Seabridge will not be in the mine building game. So you know this, and a handful of prospective partners know this. Doesn't this put them in the driver's seat? And is it completely infeasible for Seabridge to put a go-it-alone option on the table? Thanks.
Yes, it's completely infeasible for us to go it alone. We're not going to build a $5 billion project. It's not going to happen. I mean, there's some stuff we can do early on in terms of, collecting data that can be used in the final feasibility study, stuff like that. And we continue to do that year in and year out. And you're right. I mean, it is a small universe of potential partners, and it's hard to run a successful auction with one bidder. We believe now with Snowfield, we're already seeing inroads coming in from potential partners. The way you create leverage, maximum value in an auction is a number of bidders, and we believe that with the addition of Snowfield, we have definitely increased the competitive tension that should be out there on an asset of this scale. And I will close in saying that you look at the world today, the big companies are running out of reserves. They're generating huge cash flows today, though, with gold and copper at the prices they're at. They need new projects in their future. There's hardly any big projects out there available to them that are in a safe jurisdiction, that are capital efficient, and are ready to start construction. KSM checks all those boxes, and I think, we've been talking about a partnership for years. I think the stars are finally lining up here, that we will be successful in getting a deal done on terms that'll make all shareholders happy.
Okay, we've got Scott has several other questions. John Bolin.
Yeah, thank you. Sorry about that. My mute was acting up. Okay, this is a question. Could you provide an update on infrastructure cost, i.e. the proposed extension to the Eskay Creek Road? Is that still #1 option? Any cost and lead times on that? Also, will a road be built between Snowfields and KSM? Thanks, from Peter, a long-term shareholder.
Yeah, there'll be roads between Snowfield and Mitchell. They're only 400 meters apart, and we actually had road designs in our mine plans already into their claims. We put a joint cooperation and layback agreement in place with Pretium years ago, so obviously there'll be roads there. Yeah, the road from SK down into the KSM is still on the drawing boards. It's still planned. It's in our capital budget. There's also a road that comes in from Highway 37 to the saddle area, as well as to the mill site. All those roads are still planned. So again, nothing really changes in terms of project layout with or without Snowfield.
Thank you. I actually have one more question that Mike Hahn would like to ask. I'm gonna see if he is still on. Mike, can you hear us?
Hey, yeah, one quick follow-up, Rudy. I got kicked off when I switched my mic, and you were talking a little bit about the structure of a deal, a potential deal, just loosely, with one of these partners. And I think you said 30% ownership, 10% of the capex. Would you see any kind of a I'm thinking of the Trilogy deal and things like, would you see any kind of an upfront payment along with that, do you think?
To be honest, an upfront payment to us doesn't mean much. I'd rather see the upfront payment go into the ground where the project gets developed quicker. Our focus has been, and our conversations have been, dollars into the ground to drive the quickest path to a construction decision. We don't need to line our pockets with an upfront payment. If somebody wants to pay it, that's fine. But our focus has been concentrating expenditures into the project to get to a construction decision.
Okay. And then the three other projects you're talking about and Courageous, how much in total did you spend on those to buy those?
So I think Courageous we bought for $5.5 million in cash to Newmont in 3 tranches based on the gold price, and that led to 11 million ounces. So, you know, obviously a good return there. Then I think we probably put another 30 million or so into it to complete pre-fees and drilling we did there. And you know, Iskit was I think it was a share exchange. Jim, correct me if I'm wrong, but I think it was about an $8 million transaction.
Yeah, that's right. That's right.
But it wasn't a lot. For Snowstorm, we issued Paulson 700,000 shares and 500,000 common share purchase warrants that expire next year. I think they're good at, they're struck as 15.65 a share Canadian or something like that. Mm-hmm. 3 Aces, we issued 300,000 shares.
Right.
Okay. All right, great. Thanks for staying on the extra time, Rudy.
My pleasure.
Thank you, Michael. Okay, I want to proceed to close. I want to really thank Jim Anthony for giving us the macro picture, and Rudy, great presentation. I'll turn it over to you for closing remarks.
Yeah, well, thank you, everybody. That was the longest town hall meeting I think we ever have, and probably the most attendees, probably driven by our announcements last week. Just thank you for your patience. Thank you for your time today. If you have any follow-up questions, don't hesitate to shoot me an email, rudy@seabridgegold.net or rudy@seabridgegold.com. Either works. I just will close in saying that I've done a lot of deals in my career, some good, some bad. This, though, I would think we'll all look back on as not being not only the largest, but I think over time will prove to be the most accretive and meaningful to our shareholders. So stay tuned, a lot to come on this, and again, thank you for your time.
Thank you, Rudy and Jim again. Thank everyone for your attendance today. We'll be following up for feedback, and I wish you a very pleasant evening.
Take care. Thanks, David.
Very welcome.